This is Market News First. News you can trust.
Albom, Microcap Engine, thanks so much for joining us. And you are here again. MN1.com into the future, and away we go here. It's our job at Market News First to make the markets efficient, to help shed light upon the good stocks and the bad ones so that you can find the investment gold, make money, profit, and benefit society. That's why we're here. And to help us here, we have Gary Dorsch on the line, the editor of the Global Money Trends newsletter, one of the official economists here at the Microcap Engine. So because he's got so much good stuff to talk about, we're going to bring him up real fast. And when he's done at the 15 minutes past the hour, we're going to get a microcap update, a portfolio update, and head right into major news and the market news. So let's go ahead and bring up Gary. Gary, this is Saul Albom, Market News First. How you doing, sir?
Hi, Saul. Great to be on your show today.
Oh, great. Thank you so much, and appreciate you taking the time with us. Now, we've had Ford and GM, or I should say GM, come together with, with the unions. We've had durable good orders. We've had housing numbers. We have interest rate cuts last week. We've had balance sheet bombshells, yen carry trade, all kinds of movement going around. What are some of the major factors that you're looking at, Gary?
Well, the signs that the U.S. economy may be tilting into recession just continue to mount. Yesterday we had some news that the pace of U.S. existing home sales had fallen sharply in the month of August to a 5.5 million unit rate, annual rate. That was down 4.5% from the previous month, and the weakest sales rate in 5 years. But the real bad numbers on that report yesterday were that the amount of unsold homes, of unsold inventory, reached 4.6 million units, and at the current sales rate, it'll take about 10 months to sell a house in the United States. That's quite a difference from just 2 years ago when it might have taken 10 days to sell a home. Now it could take up to 10 months, and that's the longest waiting time in about 18 years. So housing prices appear to be coming down. There was a report that U.S. home prices across the nation, on average, were down 3.9% last month from the previous year, and in the top 10 cities in the United States, down 4.5%. Former Federal Reserve Chairman Alan Greenspan did predict last week that he was expecting U.S. home prices to be dropping in double-digit rates. So a further slide in U.S. home prices could really hurt consumer spending, since many American households use their home equity as an ATM machine. And if the ATM machine starts to decline in value, and there'll be fewer loans, especially with a lot of banks now tightening up on their lending standards. So it's likely that the U.S. economy is probably going to be tilting into recession in the next 3 to 6 months. And yet the worse the news on the economy, the higher the stock market goes.
Do you see that as a ramification of the carry trades?
Well, if you're trying to be a macroeconomist and trading the stock market, you're going to lose money. What you need to do is focus on liquidity. Weaker economic numbers will translate into more money printing by the Federal Reserve, which in turn will push up the price of assets. So you want to buy anything that the Federal Reserve cannot print, and that would include gold and commodities and even stock markets around the world. So nowadays, a lot of asset traders or fund managers are using stock index futures as asset plays to benefit from higher inflation.
Now, you mentioned that there's going to be, or there has been, lots of repos. Can you get into that and what they're doing with the money from the repos?
Well, some people love the fresh smell of coffee in the morning. I love the fresh smell of repos in the morning. As every morning around 9:45, about 15 minutes after the opening of the New York Stock Exchange, the Federal Reserve enters the market and pumps in billions of dollars into the market. Yesterday, the Fed pumped in $10 billion, and on Friday, the Fed pumped in $17 billion. And earlier today, the Fed came in with a $15 billion repo. Granted, a lot of these repos are for very short-term nature, from 1 to 2 days. Some of them are as long as 14 days. But as long as the Fed keeps coming in every morning and replenishing the money, it seems to jig up the market. If you watch very closely, as soon as the Fed comes in and announces its repos, you'll see the Dow Jones shooting up 50 points within a few minutes. And that's a pattern that I've noticed over and over now for the past several weeks. So altogether, the Fed's repos have probably total about $350 billion. Those are being rolled over and supplying a lot of liquidity to the market. The odds are now that the Fed will continue cutting interest rates in the next few months. If you look at the yield on the 2-year Treasury note, it's at 3.9%. That's about 85 basis points below the Fed funds rate. And it's been a very good forecaster for the last 20 years of where the Federal Reserve will push its interest rate. So it's very likely that the Fed will cut interest rates by another 0.75%, from 4.75 down to 4%, perhaps by the end of the year. And that means the Fed will have to be printing a lot more money in order to enforce the lower interest rates. And the more money they print, the higher the stock market goes.